Good evening. I'm John Batchelor. This is the John Batchelor Show. The World Bank is out with a forecast that is gloomy. It is not catastrophe, but it is not the direction we want to be moving in here in this coming into the second half of 2013. And I follow Bloomberg. The World Bank cut its global growth forecast for this year after emerging markets from China to Brazil slowed more than projected. But while budget cuts and slumping investor confidence deepened Europe's contraction, Europe's in a recession. The United States itself is rocked by concern that Mr. Bernanke and the Federal Reserve are going to start to cut back on the QE bond purchasing they've been doing these last quarters. All this translates into concern that is inchoate. At the same time, it very much could be the road ahead. This sluggishness has now spread from the United States to worldwide. We're looking especially at China because that was the engine that worked for 20 years. Gordon Chang of Forbes.com is here with me. Gordon, you have for some time led me to understand that China is slowing much more quickly than the statistics coming out of the buy-side statisticians, the metrics in Asia. But now I'm told that even the sell side are agreeing that China is slowing. We could see this. Can the Chinese economy adjust? Can the new leadership in Beijing adjust to this emerging market slowing from China to Brazil? Have they got a magic button?
No, they don't have a magic button. They did have one in 2008, 2009, and that was massive stimulus. But now they've just poured so much money into the economy that pouring any more is not only going to be just ineffective, it's also going to be counterproductive. Because what it will do is it will reignite the property bubble. And the property bubble is the result of their overstimulus in 2008 and 2009. They really do not have any tools except for fundamental reforms of the economy. But they can't do that, John, because the entrenched interests now dominate politics in the Chinese capital. So they have nothing they can do. They can watch this economy fall apart, and that's exactly what's going to happen.
Did this come up in the conversation between the leader of the Communist Party, Xi Jinping? And I emphasize, he's not an elected leader. He has no legitimacy, Xi Jinping. He sits there as the head of the Communist Party, a tyranny that is the one-party state, controls everything in terms of the economy and the military. The PLA works for the Communist Party, not for the people of China. The head of the Communist Party sitting across from the President of the United States. Does the President raise in this recent conversation the weakening Chinese economy, that the miracle is over?
Well, I hope that he would have, but I don't think that he did. If you look at Thomas Donilon, National Security Advisor, he gave a wrap-up after the two-day summit. He went through all the issues that were discussed, or at least all the ones that he wanted to talk about, and there was nothing about China's slowing economy. There was actually very little about trade. The only economic issue that was touched upon was cyber hacking, because Donilon said that that was going to affect all of the economic relationships between the United States and China. So apparently it didn't come up.
We welcome Charles Ortel, Managing Director of Newport Value Partners. Charles, Europe is in a recession. That's inarguable. And China and the emerging markets are now slowing. They've been downgraded by the World Bank. Okay, what's the good news? Good evening to you, Charles.
Well, thanks for having me, John, and hi to you, Gordon. The good news is that it's almost summer.
Okay, all right. Back to the United States. Were we counting on China's recovery? Was Europe counting on China's recovery? Are we now all in a place that was not anticipated 6 months or a year ago?
Well, no, I think some of us have been noticing for some time that all of the major economies in the world have benefited from the fact that nominal interest rates have been able to drop off very high peaks in 1981 down to their current levels. But I think that game is over, and I think the chief driver of interest rates around the world for the moment is the United States. Not only is our 10-year interest rate well below the 50-year average, it's at 2% versus about a 6% 50-year average, but the overnight rate, really the kerosene that keeps the flame going of the banking system, that's on the floor, down at about 14 basis points, which is way, way under the 50-year average. So I think the penny has dropped that massive deficits, crazy monetary easing has not worked in the United States. It's not going to work in most other places in the world. And the invisible hand that's been kept in the box of the global economy or outside the box is now going to come back in the box, and we're going to finally have to do restructuring of these major global industries that have too much capacity.
You know, it's very interesting, Charles. The Wall Street Journal today, their lead story was about how investors around the world have sort of see the world now in a new paradigm, and the money is coming out of the emerging economies, such as China, such as Brazil, and it's going into either the United States or proxies for the United States. And I agree with you. There's so much that needs to be done to restructure the American economy, so much that we have yet to even think about. But nonetheless, we are the best-looking economy out there. I mean, as bad as everything is here, we're looking pretty good.
At sub 2%, that's not good.
No, but it's a real 2%. And, John, that 7.7% that they claim in China, that's unreal. That's 2%, 3%. But that 2 to 3% in China is economically useless production.
You tell me the commodities are declining. That's why the emerging markets are rocked right now. That means the money from Europe, the money from the United States is coming back. Charles, where is it going? Where the money goes where it's treated best. What do they put it into the Federal Reserve for 5 basis points?
Well, I think you're seeing some people put it in dividend-paying stocks that have yields higher than the depressed 10-year risk-free rate. So there are quite a few global names that have dividend yields in the 3.5%, 4% versus the 2% 10-year bond. But what I think the next phase, it's almost like we're getting all the gathering storms at once, including the one that's going to hit the East Coast shortly in the United States, that people are going to start to think next about, when you look at consolidated financial statements for what you think is an American name, is it really an American company? Same in China, same in Europe. The financial statements that people look at on the equity front disguise the true geographic proportions of what's going on in these large companies. As for the sovereign debt of these big nations, name a big nation that's well run from a fiscal standpoint.
Well, really, you can't, and that's interesting. You know, your point earlier, and I think it is absolutely the critical one, is that the world needs to adjust with fewer coal mines, fewer handbag factories, all the rest of it. And I think that essentially the one strength of the United States, and to a certain extent of Europe, is that we've been making this adjustment since 2008, 2009, whereas the emerging economies have not done that. What they have done is they've added capacity. So I think that they're really at much more risk than we are today, because they have not made the changes and the restructuring that has to occur.
Gordon, pressing you on the China story right now, is China putting in the education for its population or for its investor class for what we're seeing in front of us, or are they in denial?
Well, you know, Tom Friedman talks about the greatness of Chinese education and all the engineers they're turning out. But when you actually look at the reality of it, you know, the Chinese are going to school in Europe. They're going to school in the United States, like Xi Jinping's daughter. So, you know, essentially, yeah, they've got a lot of people who are educated in China through the college system, but those are crap educations for the most part. And the interesting thing is, China cannot employ its college graduates, which is really a major social stability problem for the Communist Party.
Charles, right now, the investor class in the United States, is it looking at turmoil it didn't expect?
I'd say the seasoned billionaire 30-year veteran types are totally prepared for this. The people who got their start in, let's say, 1995, 1999, they're not going to know what's going to hit them. Because the way this is going to happen, it is not going to be something like over the course of the summer there's going to be a shock. It'll be faster, I think, than what happened in August, September 2008. You'll go in one day thinking things are fine, and in the middle of the day there'll be an avalanche from all sorts of directions, and people better get prepared.
Charles Ortel is the managing director of Newport Value Partners. Gordon Chang of Forbes.com. I'm John Batchelor.